Comments coming in from Deputy Chairman of the Planning Commission, Montek reacting to the government's mid-year economic review and the road ahead as far as reforms are concerned. Also talking about the government's expectations from the RBI. Here's Montek in chat with Nitya.
We've seen the mid-term economic review. The GDP forecast has been brought down to 5.8 from around 5.9 from around 7.8 levels. What does that mean really for the industry and as far as the economic story in India goes?
Well, I think the main thing that forecast means is that the second half is going to be a lot better than the first half, because the first half GDP average was around 5.4. So if the finance ministry is projecting 5.9, what it means is they expect GDP in the second half to be a lot better than 5.4. I think that's correct. It will be better. I do believe that the economy has bottomed out, but of course what it will be depends on how fast we start recovering. I mean, it's too early to predict, but I'm glad they're forecasting in the right direction.
All right. As far as inflation goes, we're given to understand that it could cool down to 7% levels by as early as March. Now, is that a fair estimate? And what do you think needs to be done on the policy front to actually ensure that this happens?
Well, I think it is fair. I mean, we've also been of the view that, you know, inflation has been, as you put it, cooling down, though not as fast as we would like. It still remains a little uncomfortable. But I think in these matters one should look at the underlying trend. I do believe that the most important thing from the inflation point of view would be to ensure that we have a genuine recovery, so there's more supply in the system. Clearly on the agricultural front, a lot depends on agricultural production, which hopefully will be good. And that there won't be too much of a price pressure globally. That is likely because I think while energy prices are likely to remain high, other prices are softening. And you know, the global economy is in such poor shape that I don't expect to have to see any transmission of global inflationary pressures in the remaining 6 months of the year.
All right, Dr. Ahluwalia, from 5.4 to 5.9 levels, we're seeing inflation, the likelihood of it cooling off. Now, I know you would not comment on what the RBI should do, but do you think the pitch for, you know, a softening of rates is made a very strong case for a rate cut from the RBI? Do you think that's made?
You know, I've always felt that there's far too much focus put on what the RBI does on the repo rate. You know, the repo rate is not like the Fed funds rate, where when they announce a Fed funds rate, they're actually saying we're going to lend freely at this rate. The repo rate is actually a signal. It's a signal of whether the RBI feels that things are improving. Now, whichever way you look at the Indian economy, and particularly if you look at policy, I think people are feeling much better about it today than they were feeling 6 months ago. So to that extent, the more important thing really is that to support a revival, we may need more resources in the system. That brings in the issue of the CRR and not so much the repo rate. You know, long-term interest rates are not determined by what you do on the repo rate. They're determined by the size of the fiscal deficit, the total flow of resources into the economy, international confidence, how much money is coming in, etc. So I think there's too much. I think the RBI should be allowed the privilege of deciding the repo rate in privacy.
All right, Dr. Ahluwalia, before I let you go, one last question. They're talking about reining in fiscal deficit at 5.3 levels. We're seeing the divestment drive as far as, you know, they've mentioned that 30,000 crore rupees will be a bit of a challenge. But given the fact that, you know, it is only you have a couple of months left in the year, you think it's an achievable target? Is 30,000 crore going to be a challenge that is not going to actually be achieved?
Well, you know, I'm not sure how important a particular number is. I mean, it's very clear that the finance ministry and the government are quite determined to rebuild the momentum on the sale of public sector equity. Whether they reach 30,000 or not is not the important thing. The important thing is that we're not saying, no, unless we can reach X or Y price, we shouldn't sell. We'll gain when markets are sort of soaring, and we may not gain so much when they're not. But I think disinvestment is on track and is working. The fiscal deficit doesn't just depend on disinvestment. It depends on everything else. I mean, what happens to revenue, what happens to expenditures. So I'm glad that the finance ministry is signaling that they're taking the 5.3 target seriously. You know, it isn't so important what the exact number will be. What is important is, are we credibly moving to a medium-term fiscal consolidation path. I think the government, the finance minister has definitely said that that's what he intends to do. And we'll have to see how that works in the budget and later on. That is very important. So in my view, for example, if people think that, you know, the fiscal deficit may be exceeded a little bit, but, you know, next year they're really going to come down, that's as good as sort of whether you exactly hit 5.3 or not.
Okay. Thank you.